All right. Good morning, everybody. New quarter, new month, new week. Things were starting out pretty good around the world. Market just fell out of bed real quick right before I started streaming. But other than that, we are gapped up with the liquidity gap added to that. So it kind of makes sense that we're headed back down to get that cleaned up. But as you can see, green around the world. Japan down, after that aggressive move that they had over the last week and a half, looking at the Nikkei, it's not much of a surprise that we're getting a bit of a pullback in Japan. UK basically flat. They've got a lot of economic data coming through. I seen Finance Juice had some economic indicators report. Haven't had a chance to read it. I've just seen it just pop up. S&P's up a quarter with the Dow, and small caps doing better than both, with the NASDAQ leading the way. But it was up the most. It's likely going to fall the furthest in this little pullback. And leading the pack, Hong Kong, which, I think it's time, right? We've been talking about China's stimulus, how they continued to push and push and push, and it really didn't seem like they were getting anywhere. There's the old adage that at some point the market's going to give up and go the other way. It didn't. It just kept holding the line, dragging along the lows. But I think those China ADRs in this new quarter are going to be a part of that rotation, right? The crowded trades like the Mag 7 and all of that, they are just so very crowded. And if we're going to see money spread out into other places, I would not be surprised if one of those places happens to be Hong Kong. So those China ADRs, BABA, Baidu, JD, PDD, maybe even some of the EVs from China, NIO, XPEV, a company I like, EDU. Those will be ones worth keeping your eye on, not just this quarter, but we want to see it flourish even this week. We do have ISM manufacturing this morning. It's kind of a big deal. I don't think it's going to be as big as what we had at the end of last week with core PC, the PCE and Powell. Speaking of Powell, we got him again on Wednesday. So just something to keep in mind. And he's not the only speaker this week. We have a lot of speakers this week. There's going to be Fed chipping their teeth around the world nearly nonstop every single day in Globex and US trading hours. So just kind of keep that in mind, right? Don't be complacent. Watch the clock. The government's lazy. It does things on a half hour and a 1 hour basis. And even if you don't know what the economic event might be at, I don't know, 1 o'clock in the morning or 1 o'clock in the afternoon, you still know it's a new hour. You could see elevated flows coming in. So if you're trying to run tight stops and things like that, you're very likely going to get stopped out on a new hour. We do have additional auctions, as you can see, 3-month, 6-month, all up in the front end. Use something like the IRX to kind of get a better view of that front end. Still seems like everybody took Powell as some sort of a hint or suggestion that we're going to get rate cuts starting in June. Remember, you can always come over to the CME Fed Watch. This is a free product. It doesn't cost you anything. I'm not signed in. You don't need to buy anything to be here. And you have the opportunity to check out the different FOMC that is upcoming. So if you look at June, and we'll look at July in a minute, the current rate structure, just choose one of these two numbers to make things easy on yourself. You don't have to read both numbers, just choose one. So if we say that the current rate is 5.5 or 550, then when you come down to the bottom, look at the same number. If you choose to look at 525, the front number, then down at the bottom, also look at the front number. So we can see that they've got this rate cut priced in for June at a 66% probability that the Fed is going to cut in June. We look at July. There's a 50% chance that we will have our rate cut by July. Now, there's a couple ways to look at this. If we didn't get one in June, which would lower us down to 500 if we just use that front number, then we could get a rate cut in July that would lower us down to 500. The other way to look at it is we get our rate cut in June, that takes us to 500, but then we don't get one in July and we're still just at 500. The probability that we would get a second cut and that we would be down at 475 by, I keep saying June, by July would be, there's a 28% chance of that right now. So a 50% chance that we'll get a rate cut to 500. That's just one rate cut, 25 basis points in July. But look at it for June, there's a 66% chance. So they're feeling pretty good that we're going to get a cut in June or July. That would seem like the most pressing thing out there right now, but it's not. There's the May 1 FOMC meeting. Now, as you can see, this one is not pricing in a rate cut at all. We're at 5.25. This is saying there's a 96% chance that we're going to still be at 5.25 at that FOMC meeting. But that's not the issue. This FOMC meeting happens to also be when we get the next QRA, quarterly refunding announcement, right? Yellen with the bonds. So that's going to be kind of a big deal and has to tie into this. So the data that we're getting this week, the Fed speakers that we're going to be listening to this week, they need to support this narrative that the Fed is looking to cut in July, maybe in June. And if you want, you can flip that around. Cut in June, maybe July. Between the both of those, there's a really high probability, but worse than that, or more than that, depending on how you want to look at it, they've priced it in. So a cut is priced in. And if they start getting data that says we're not going to get that rate cut in June or July, then the market's going to unwind those rate cuts and we're going to go down. Now, I'm not talking about, falling like a bear market, crazy deep lows. Just that we wouldn't expect a continued rally, wouldn't be looking at new highs. We'd see another stagnant, sideways, choppy market, probably with a 500 to 700 point range. And we would just be on hold at that point, looking for when the rate cut would be, so that they'd start pricing it in at that point. So we're on watch, listening to these different Fed people come out, give their reports, speak their mind, give clues, and we're watching the data to see if we're going to reinforce this narrative of a rate cut or if they're going to need to unwind this. Now, if you scroll down, you can see how things have changed from one day, from 1 week, and from 1 month. So it's not like you got to sit there and stare at this thing all day. Just check on it once a day, see what they're doing, and it'll give you a better idea of what's going on in the price action. If they're unwinding a hypothetical rate cut or if they're doubling down and pushing it even stronger, right? Because right now we're looking at a 50% in July and a 66% chance in June. So those are the ones we want to keep our eye on. We're going to get some jobs data later in the week, pretty much all week. You can see we've got jobs data through most of the week, but the really big jobs data is the non-farm payrolls. This is the biggest one that you really want to pay attention to this week. It's the money maker. It's the one that's going to have the opportunity to create the most volatility, and it has the greatest impact on what the Fed says they're going to do. During the FOMC announcement, Powell talked about jobs a lot. They're focused on this number. So we want to pay attention to this number. something else to kind of keep track of as we get deeper into the week. We could start to go into a hurry up and wait mode, likely by Wednesday afternoon, and get into kind of a choppy sideways market through Thursday and into Friday morning, looking for those numbers. Also, the 10-year bond tonight in Japan. This is a really big deal as well. Just like with our auctions, the 10-year is a big deal. The Japan 10-year tonight has the capacity to really rock the markets. And I know it doesn't have it listed here. They never show auctions as potentially impactful, but those auctions are something that I pay particular attention to, always have, and want to keep that in mind. We could see some overnight volatility because of this auction. Right now, everybody seems all lit up that we're going to get a rate cut, especially in the US and in Europe. This is what I was mentioning when we first started about how there was some indicators for Europe. That's worth a link. Click on it, read what they have to say. It's going to discuss their opportunity for a rate cut and the economic events that are coming out this week that might support that cut or not. All right, so we can see the volume is really light. We're sitting in the 40s. This is kind of a big deal. What are they sitting out for? All right. You always want to have an understanding of what's going on in the overnight hours. If they're sitting out waiting for something, then we want to know what it is. They're not hedging so far, whatever it is that has caused them to sit out. We just went through all the data. We're not seeing anything in there that that would cause the low volume, but we can see right here, London is closed. So whether it's because there is a holiday or some other reason that they closed, they're not open, and their lack of volume is why the volume is so light this morning. Generally, they'll have something in here for holidays. April 1, closed for Easter. There you go. So that will explain why the volume is light. It's like I've said before, use that volume as a gauge. It should be sitting somewhere in the 60s, 70s, better in the 80s and 90s. So when we see it sitting really low in the 40s, we want to know, why is it so light? Is everybody sitting out waiting for an event? Or is there a market closed somewhere around the world? Europe's closed. That accounts for the low volume. We're good. Just keep in mind that's also going to change how things look at 11 and 11:30. Europe closes at 11:30 market time. Without that close, we aren't going to get that same kind of midday move that the S&P has a habit of making. So kind of a big deal. We have an MDP from Friday. We did not hit the pivot point on Friday, so that makes it an MDP, a missed daily pivot. And so far this morning, we have not hit the pivot point again. The one from Friday counts now. The one from today won't count until tomorrow. This is not a strategy that I trade. It's just a concept that I use to kind of analyze the market and it's not mine. I didn't make it. You want to know more about it? Just hit YouTube, type in missed daily pivots. You'll hear all about it. Again, I don't trade it, but using it for a basis of just kind of getting a feel for what's going on in the market, what some expectations are. Markets hit that pivot point at least 80% of the time, right? So when we don't hit it, that means we're doing something unusual. We're in that 20%. You watch the videos to kind of pick more up on it from there. But when we're above it, we're bullish. When we're below it, we're bearish. We're above the weekly pivot as well, and we're not yet wildly overextended from that weekly pivot point. Above the volatility trigger, we're outside of the previous week. In fact, we came down and tested against it after breaking through it in the Globex last night. The call wall still sitting at 53, 56. It's a long ways away on the other side of the ADR half, and a voodoo line plus some round numbers, 53.50. So a lot of resistance overhead to get to that call wall. Let me use this blank chart here with really not a lot of indicators on it to talk about this gap for a moment. So on Sunday night, we opened up here. This is a gap all by itself. Then there's a concept that I like to use called a liquidity gap. We had this really big expansive candle. So where we opened is a place that I would expect to see price come back to, since that is the liquidity gap that needs to be closed. But we still have this other gap, this gap from where we closed on Friday and where we opened on Sunday night. So two gaps, one a real gap, and then the other just a liquidity gap. So it wouldn't be a surprise to come back down to where we started. And that does make for a really big IB, an initial balance. Really, this would be the initial balance. All right, 10-day, 30-minute volume profile. We still have a little bit of a discrepancy between the TPO profile and the volume profile. It's not really too big of a deal. Both point of controls are in the upper area above this bubble. We do still have more of a classic B shape right now. But as the week goes on and we lose this lower volume down here, we're going to end up with more of a classic T shape that will finally get chopped away, and then we'll have more of a D shape. We'll be at that point here, right? So we're going to lose all of this as the week goes by. Obviously, that's going to get us through probably Thursday before we get to that point. And the only way we would still have a D is if we don't expand higher than this. So that 53.33, which happens to be a cog line, would need to stay as our high. And then we need to keep this low and just stay here chopping in this zone. Now we could do that, but that's a really tight zone. And with everything on the table this week, especially after the whole hurry up of last week, hurry up and wait, hurry up and wait. That's all we did last week, right? We waited in that short week, just chopping sideways, waiting on Powell. I find it hard to believe that we're going to do yet another one of those this week, at least for the start of it. When we get closer to non-farm payrolls at the end of the week, maybe, Thursday afternoon, Wouldn't be a surprise if we slow down, start chopping sideways. But until then, I expect the market to go back into a normal rhythm of movement. So we'll see if we can break this range, but at least the range is set. 52.60 on the downside, 53.35 on the upside. Let's get out of that zone. Break out above, it's bullish and long. Break down below, it's bearish and short. That might seem like a Captain Obvious statement, right? Like, well, gee, thanks. But, last week, every time we got to the lows, we bought into it. We were buying into weakness. And every time we got across the highs, we were selling into it, right? We were selling into strength. So each of those breakouts last week were sellable opportunities. Sell the rips, buy the dips. Now it's the other way around. So Friday, we took out this VPOC. We no longer need it on the chart, but we built a new VPOC at this location. So we'll just move it and take it. That should be pretty close. Yep. So we got a new VPOC and it's right on a cog line, 53.11-ish. Close enough. So to even get this gap filled, we're going to have to work our way through that VPOC line. I know there's a phrase that all gaps fill, blah, blah, blah. But look, that gap can stay there for a while. It doesn't owe us a gap fill first thing Monday morning. The thing about a weekly gap up like this, it's a really big deal. And if we see this same gap in things like the Magnificent Seven or the Fang names, and we find those gapped up on a weekly, that's crazy bullish for the week, for the month, for the quarter. It's a really good start. Look at how the volume distributed against this high yesterday when we ran up and set it. We got that nice little volume profile right there. And we didn't spend a whole lot of time there. And then we fell back out of it. The volumes down here and that point of control is really close to the mean, to the center point. Now, there's a lot of different ways that you can measure where the mean is. There's even some tools that'll do it for you. One of the neat things that a lot of platforms has is this regression line. Manually drawing your own regression line. You choose where it starts, you choose where it stops. You don't have to line up on the candles other than the starting candles. So notice I'm way down here in the lower portion. I'm nowhere near these candles. It doesn't matter. I just want to start last night at 6 o'clock and pull it across to where we're at now. And it looks like I missed it by one candle. So we'll just back it up a little. See the direction of that line. It's gently sloping to the downside, and it's really close to that point of control. So there's just a ton of trading happening right now as well. Ton. We're short volume, but this is where the bulk of all the trading has been taking place, not along the edges, right? Not buying along the lows or trying to sell it along the lows, not buying at the highs or trying to sell it at the highs. It's been right in the middle. So a couple of firms, passing the buck back and forth. Happy to do business at this price. Granted, we're gently sloping to the downside in that Linreg line, but we're really close to the mean with all of that trading activity until finally something broke, right? And then we broke down. .75% above the 10-day. We're still holding within our zone or that range that we've been talking about all year. So we're not seeing anything beyond the norm on a daily time frame. We're still more than 3% above the 10-week. We're holding that dominance since the QRA from November 1. Still hasn't changed. We can see that we've been higher than this before, certainly. But we don't generally stay higher than this for very long. We are on the decline. Looking at it, over the last few weeks, it's been pulling back. So we need to keep our eye on this, see if it's going to stabilize and turn around and make another push up, or if we're going to get a deeper pullback like we did back here in January. It's been a long time since we've pulled back that close to the 10-week, so we'll see. It is a new month. There is an open range strategy that I like to use called the door. Day one, open range. It's an open range on a daily time frame. Now, there's two different ones that you can use on a daily. One uses the very first month's candle. So here we are, April 1st, we get a new candle. We would use the highest point of that candle and the lowest point of that candle and mark it out as our open range for the month. Another strategy uses the first 3 days. So depending on how you want to do it, here's an example where we had one back here, starting a new month, like an open range on a 5-minute chart. It's not much different, right? We finally get the test of liquidity, just as usual. Remember, liquidity resides on the other side of the pivot. It got into liquidity on the downside, popped up, came through it on the other side. Now, we're looking at the futures, but this isn't a futures thing. This is just a price thing. It doesn't matter what you're looking at. Stocks, options, futures, whatever. There's always more that you can learn about it. If you were to, search online, open range, day one open range. When I first got into the open range concept, I thought it was all about intraday stuff, 1-hour charts, 1-hour time frames, that sort of thing. But there's a lot of open range strategies that's been developed over the years. This is an older one. It's been around, mid 90s at least, late 90s. So a good 20 plus years. And it makes sense too that it's one of the older ones since it does use the daily time frame, right? So something to think about, not necessarily on the futures, but on equity products, that today would be the start of a new open range. The 3-day is really interesting too. I don't have an indicator that makes the candle white for a 3-day like I do for this one, making today's white. But it's not like we need it, right? After the 3rd day, get that candle close, look for the range to get broken, trade the play. It's the same thing. Even if you don't trade it, just using it as a concept, as a piece of analysis. We weren't able to see the range projection last week. Remember, we were looking at the market on a Thursday, and this indicator wasn't drawing this week's channel like we normally would see on Friday. So we didn't know what it was going to look like. Now we can see this week's range, and we can compare it with last week's range and see that we're kind of sitting in the same boat as we were last week. I would stress a little bit of caution with that. Remember that this range is developed based on volatility, and last week we didn't have volatility. It was a volatility suppressing week. That might lull the market into a sense of calm that isn't real, especially with all the jobs data that we're going to get this week and the 10-year in Japan. There's a lot going on this week, and that seems like a very narrow range, all things considered. So just something to keep in mind. I wouldn't try to run an iron condor on that. It seemed like a good way to get run over. bring up TradingView here for a minute. I've been looking at their new screens. They've done some work to adjust things, and they had a pre-built ETF screen, which was kind of nice. I adjusted it a little bit. This is a pre-market scan for ETFs, but then I limited it, right? Things need to be up at least 0.5% or it won't show up on the list. And it needs to be up less than 2% or it won't show up on the list. And the reason I did that is there's these triple leveraged, double leveraged ETFs, ETNs, and they'll be up 8%, 10%, 12%, and it just skews the whole thing, right? So I knocked them off the list. What we end up with is something a lot easier to manage, to try to understand what's going on in the pre-market. Gold's up a lot. The indexes themselves, the Russell, that sort of thing. So miners, gold, silver, nat gas. The China ADRs were up. We're seeing some small cap stuff with ARC, those ARC Genomics and ARC Innovation. Bunch of Kathy Wood stuff. I did make one for a bearish side too. If we were bearish this morning, I got the same kind of scan. It didn't take much. If you're using TradingView and you haven't yet gone over and look at their new scanning capabilities, check it out. I mean, it seems they're working on trying to make it more user-friendly. And they do have quite a few pre-made popular screens. One of them that I found really interesting, especially looking at all this gold and precious metals that are on the move, is that they have one built for focusing on gold and precious metals as an active screener. So check out their popular screens. You might be surprised at what you would find, and at least maybe it'll give you some ideas to build a screen of your own. So Bitcoin down this morning, and bonds are down this morning, at least the 20-year. Things that are up. Uranium, gold miners, precious metals, China ADRs, nat gas, which is a joke. More emerging markets, airlines through jets, metals and mining, which kind of goes back into precious metals. We're seeing a little rise in semiconductors. It's still kind of weak yet. I want more. But we also have banking and financials. That is really bullish. Semis alone is bullish, but having finance and semis, double whammy bullish. It's a good deal, right? So we want to see that continue. Like I said, the market will get tired of that kind of a hurry up and wait mentality. It won't hold that forever. It'll just throw up its hands and wash it all out. Well, it looks like they're washing it to the upside. The problem at this point is a gap up drop, right? So I've often said I would rather gap down on a Monday than gap up on a Monday, right? Because to me, gapping down on a Monday is a much more bullish scenario. And the fear is for a blow off top. Now, we really didn't go anywhere last week, so it's hard to see why we would have a blow off top now. But we do need to be concerned that this is a gap up where we're going to fade down from here and tag that 10 and then, readjust and see what else we do from here. It is bullish to have a gap up. Don't get me wrong, right? And I don't have the numbers to say how often gap ups on a Monday differ from gap downs on a Monday, but I do have some stats on the S&P for the SPY on just gaps in general and a Monday gap. So see if I can dig these stats up. Well, it won't fit. The stat that I was thinking of showing you is the gap down stat for a Monday. that gap down gets filled like 90% of the time on a Monday. That's a very bullish thing, right? The gap up, if I remember right, is a 50-50, that there was 20 instances where we gapped up on a Monday and half of them filled. Well, that's a coin toss. That doesn't have the same statistical significance as 90%, right? Oop, that wasn't what I was looking for. So yeah, the stat doesn't fit anyway, since we gapped up and set it down. Still, this gap up, you want to keep track of it in a lot of the other equities, especially if they've had a hard time, say like Apple. Apple's been, really chopping along these lows, and getting a gap up, especially on a weekly, that's a big deal. So looking at Apple this morning, it doesn't look like it's going to stick, right? Like by the time we get into the actual open, that maybe there won't be a gap up. Gap down on a weekly, as you can see, generally a big deal. We just keep going lower and lower. But when it comes to gap ups, these where we closed red and then we gapped up on a weekend and opened and just kept on running, that's the kind of weekly gap up that I'm talking about. And even better, if it's just a true full gap where we closed at the highs, we opened gapped up the next week, and we continued driving and closed there at the highs. Microsoft is going to be gapped, it looks like, unless it dumps it all down in the pre-market. That would be still inside of last week's range, but it's looking pretty good so far. This is last week's open, so we almost gapped up all the way to that. All right, so I get it. We're a little weak in the pre-market. We're giving back these gains. It looks like we're going down, blah, blah, blah. But look, just look at everything that's gapped up and where they came from, what sectors, what industries. We got the Mag 7 semiconductors, China ADRs. We've even got small caps coming in through like the ARC genomics and those kind of things. And we got precious metals. So with precious metals, that means we got the dollar weak, precious metals up. That'll help. That just feeds the fire for the idea that we could have a bullish day today. Plus, we haven't had one of those rip your face off days for, what, 2 weeks since that Wednesday with FOMC. So I wouldn't get all bared up yet, I guess is the point. Coming back down to this 53.14 is just going to close the liquidity gap, and coming back down to 5,300 or Friday's close would just be closing the week gap. And it doesn't have to do that. But if it does, I still wouldn't be bearish at that point, like looking for a run down to the lower ADRs. You got to be short right now, obviously, because that's where the market is going. But, I'm just saying this isn't bearish yet. It's not getting into other markets, other sectors, the FANGs, semis, emerging markets, precious metals. And we have all the conditions today for an amazing rally day. But okay, this kind of changes things just a little bit. Should have looked in here a little quicker. With precious metals up, the expectation is that the dollar would be weak, the Dixie would be down, and it's not. It's pushing hard to the upside. Notice these last few candles match the last few candles here in the other direction. So we're getting a direct impact with the 10-year up, the Dixie up, the US dollar Japan up, and on the other side of that, the S&P is down, the NASDAQ is down, very likely the Russell is down. They're not red yet because they were gapped up so high, but they're certainly not doing good. And here's gold rolling over with that impact from the 10-year and from the dollar. All right, this takes all of it off the table. No rip your face off rally day, no continued bullish drive to the upside. At this point, we want to play it level by level. Let's get to the liquidity gap close first, then down to the close of Friday, into the 10-day moving average, and then down into the lower ADR, which was Wednesday's low as well. So that's a really powerful support level right there. On the other side of that, the 10-year is just about to hit the 10-day. And as you can see from Friday, it's often a rejection point. So if that rejects and begins to fall back, we could see a rebound in the S&P and the NASDAQ, which have greatly extended beyond their VWAP anyways, and are kind of due for a reversion back to the mean. The tell will be if it can get back through this half back here. If we can get through the half back, we can make it back to VWAP. So keep your eye on the news, see what's going on with Japan and the 10-year. If the dollar turns around, keep your eye on gold to see gold also turn around. We should see the dollar fall or the dollar index fall and gold rise. Otherwise, if gold continues to stay weak, we're going to expect the Dixie to continue to try to push higher and the 10-year and Japan. With those all driving higher and gold lower, then NASDAQ lower, S&P lower. That will hit the names that are up in the pre-market, but we don't know how much yet. I would say approach with caution and keep your eye on the financials. That was kind of a surprise that they were up, but now I guess it kind of makes more sense to see that the financials are up, seeing what's going on in the dollar index. So if we start to see KRE stall out, begin to fade, that might be a little bit of a helping hand. And otherwise, notice semis are down now below the benchmark of 0.5%. So we would want semis to come back. China ADRs, I guess, seem to just not care this morning. Let's see a couple of those. Oh yeah, they're still holding it. So JD, BABA, Baidu, PDD. Okay, now PDD is giving it back, but the others seem to be holding it up really well. It seems like they're not going to be overly affected by whatever's going on out there. And it kind of makes sense that they would benefit from what's going on out there. So from that point of view, you still got those. Doesn't look like they're changing. NVIDIA was gapped up a little bit. It seems like it tried to get that gap closed. You see how just aggressively bullish we were. Seems like it's really trying to unwind that a little bit at a time. Uranium is one of the top ones now. Not a lot of flows, and it's still keeping it. Then gold miners, China ADRs behind that, and pot stocks, which really didn't look like it did much anyways. But if it's just going to continue this march to the upside, we're right up into that 1050 area, really difficult zone to get through. But if we can get through it, then we've still got a long ways to go into that 14 area. Yeah, it's all unraveling. I would say get into the open, and by 10, we should have more information about uh, how much worse is this going to get. Plus, those Fed speakers might shine a little bit more on what's going on. Definitely something coming out of Japan with that move. Well, I say that, but I shouldn't. Whatever it is greatly affected Japan. Let's say it that way. And the 10 years made it through that 10-day moving average. So the rejection that we talked about like Friday, we didn't get it. So very likely going to continue this sweep to the downside, at least down into the 3-day moving average on the NASDAQ and the S&P. Everybody, be careful, be safe, have a good week. I'll see y'all tomorrow.